Daniel, what do you make of the fact that we're seeing futures, they're higher right now, not really responding to the idea that potentially there's a break in the ceasefire? It seems like investors seem pretty confident that the ceasefire will hold.
I don't know if I'd say people feel terribly confident, but there is clearly a baseline assumption in all of this that even before the announcement of the ceasefire, frankly, a belief that this wouldn't escalate too far. If you looked at the reaction, even when you did see oil prices move up, gold prices move up, it seemed relatively limited given to the potential that everyone worried about in terms of the consequences. And now at least that confidence does seem to be justified, but like you, watching the headlines minute to minute.
All right, fair enough. It does seem like investors were kind of shrugging off some of this conflict, at least the idea that it would intensify even more from where it is right now. So with that in mind, let's go back to the U.S. markets. Where are you seeing opportunities at right now? The VIX has certainly declined right now. Bond yields have declined as well.
Well, overall, I mean, we're modestly overweight equities, so we see opportunity in equities more broadly. I think it's a bit more challenging now to have a high conviction view on a particular region or country. So actually, we're neutral in terms of our geographic allocation within equities. So there's kind of good news, I think, that you can talk about for a lot of markets, but not that real divergence like you had immediately post the U.S. election when everyone was so very much overweight. U.S. equities, it seemed an obvious trade, even as we know it didn't quite work out that way. I don't think you see that level of conviction when it comes to the regional call for equities right now.
I mean, I want to, again, focus on the U.S. market, if you wouldn't mind. I mean, just with the idea that the Fed is looking to ease right now, and also that these geopolitical tensions seem to be at least lessening. I mean, I think it's fair to say that we don't exactly know what's going to come up. Wouldn't that be a time to maybe invest in cyclical sectors, whether it be financials or industrials that continue to lead the market? I mean, wouldn't those be the areas you might want to put some money to work in?
I think that makes sense. Also, another area that we've been looking at is U.S. small cap. So a bit along that idea, if you do see sustained growth in the U.S., of course, ever since the Liberation Day announcements, the question has been whether or not growth will hold up in the face of the tariffs. But if it does, if we see the U.S. economy holding steady, you would, for example, anticipate U.S. small caps outperforming, which they have done relative to value stocks in the U.S. There's always a question about how well small cap will do versus tech. And more broadly, in terms of cyclicals, let's not forget one of the reasons that investors were so positive on the outlook for U.S. equities post the U.S. election was partly taking tariffs into account and seeing that as an impetus for increased investment in the U.S., again, something that ultimately should benefit cyclical stocks, as you mentioned.
Dan, I want to pull on that thread about the small caps. Right now, we're actually looking at the Russell futures. They're up over 1%, actually doing better than the NASDAQ even is right now. When we talk about small caps, we act like it's like a monolith, like it's everything's the same when we're talking about those 2,000 stocks. But there's certainly different areas. There's financials in there. There's industrials in there. There's a number of other consumer-facing businesses. Is there a certain portion of small caps that you see opportunities in?
It's almost to some degree what small cap isn't as opposed to what it is. So what I mean by that is if you think about your U.S. allocation, even to the S&P 500, the story over the last year and a half has been how much tech has driven that, Mag 7 and so on. And the dilemma I think that poses certainly for investors in Europe, I'm based in London, is that maybe you like the outlook for U.S. equities, but if you increase your allocation to the S&P 500, you're kind of implicitly betting more on that tech call, and maybe you feel you don't want to go much further on that allocation to tech. The appeal of small cap then becomes that you can increase your exposure to U.S. growth without increasing your exposure to the mega cap tech. So we see it kind of that diversified access to U.S. growth, but excluding the mega cap tech is one of the key advantages of the U.S. small cap.